Thank you for coming to the Federalist Society's panel on the future of housing finance, put forward through the Federalist Society's project on regulatory transparency, a new project at the Federalist Society where we have a number of different groups across the policy spectrum. You can check out on our website the Regulatory Transparency Project's many activities. There's some really fascinating videos about things from the regulatory environment affecting people developing new food, non-meat, meat projects, and all kinds of things you've never even heard of, but a fascinating website for you to check out. But let's get back to housing finance, and it's my real privilege today to introduce Dr. Mark Calabria. Dr. Mark Calabria is one of the proudest sons of George Mason University's economics department. The thing that I've always admired most about Mark is that he has accomplished something that I think many people in Washington aspire to. Some people, like me, think they have achieved, but that he's actually achieved, which is, I think, a mastery of the triad of skills that you need in Washington. The academic depth and rigor combined with policy expertise, combined with political skill and instincts. And I think that triad is incredibly rare in Washington. And it's also rare for it to be joined with a commitment to public service and to the American taxpayer that Mark has demonstrated through his entire career. Mark has his PhD in economics from George Mason University, as I mentioned, and his dissertation advisor was Dr. Richard Wagner, who was himself an acolyte of James Buchanan, a Nobel Prize-winning economist. And so Mark is the true heir, intellectual heir, to the Virginia Economics School of Public Finance and Public Choice. He served as chief economist for Vice President Pence. He served as chief economist for the Senate Banking Committee. He served as a deputy assistant secretary at HUD, director of the Cato Financial Policy Studies Center. So he's pretty much done it all in finance and policy. We're really excited. I think all of us in the DC policy community are excited to see Mark in this role. The perfect man for the perfect job at the right time. And luckily today we're going to hear everything about the future of what's ahead at FHFA and its regulation of the government-sponsored enterprises. So please join me in welcoming Dr. Calabria today.
Thank you, JW, for that very kind introduction. Let me also congratulate you on the recent birth of your fourth son. I hope you're managing to get some sleep in there on occasion. Let me also, how honored I am to precede such a distinguished panel of experts. You know, to put it this way, I kind of feel like one of those new bands that have like one album out and then you've been asked to open for the Stones. So I'm gonna leave it up to your imagination on the panel who exactly is the Keith Richards of mortgage finance reform. But it is quite an honor to be able to get the crowd motivated for that. With that, I will keep in mind that the two rules of being an opener, which is you stay within your allotted time and you don't show up the headliner. So, but with that, let me also just really express my admiration for the work and objectives of the Federalist Society. If I could really just state out a few principles that I've lifted from your website, and I lift them because I share them so deeply, which is, quote, the state exists to preserve freedom. And I think that's something that's important to fundamentally remind ourselves about on a regular basis. Also, the separation of government power is essential to our Constitution, in that it is the province and duty of the judiciary to determine what the law is, not what it should be. And so I think it's appropriate, given the venue for the Federalist Society and given the history, that maybe before I get to some details about what we're going to do and what we have done at FHFA, I can just spend a minute or two talking a little bit about my own legal judicial philosophy, if you will. And since I'm an economist, not a lawyer, I will beg the indulgence of the lawyers in the room. But I will say first and foremost, I'm an Article I guy. And to demonstrate that, I think I even have my pocket constitution with me today that I carry around. I like to encourage other regulators to do the same. And why this is important is at the end of the day, I leave the legislating to the legislators. And that may be sometimes imply that there are things that I would love to do as policy, but I don't have the statutory authority, so I don't do that. It also means that there may be things in the law, and of course, not mentioned, my time on the Banking Committee spent working on the Housing Economic Recovery Act that created the agency to which I run. In lots of things I like in the law, maybe a few things I don't like. You know, you do make compromises in the legal process, but being an Article I guy, I'm committed to, we carry out the entire statute, whether the things I like and the things I don't like, we carry it all out. And that's the responsibility of the job. Let me also say, and I think this is particularly relevant to the GSE charters, I'm an enumerated powers guy. If it isn't in the paper, if it isn't in the charter, they're not doing it. It's that simple. I'm not going to spend any time twisting myself into a pretzel or getting my general counsel to come up with creative interpretations for me to do things that aren't in the law. So we stick within the four corners of the paper. And again, if Congress wants to tell us to do something else, they have the ability to do so, and we will carry it out if they do so. And I think it's important to put in mind and perspective a number of the choices that I have made in the last 8 months and the choices going forward really are informed by we're going to carry out the law, we're going to stick within that. I will mention probably the foremost of that is, somehow, and I think I can only really, even being generous, call it a myth, that has developed over time that somehow the regulator is supposed to wait for Congress before releasing the entities from conservatorship. That is a myth. That is absolutely, utterly inconsistent with what the statute says. So the exit of conservatorship, which I'm going to talk about, it's not a choice, it's an obligation. And I carry out my obligations as under the law. And unfortunately, and I think this is something I really do want to commend the Regulatory Transparency Project here, because so much of the focus really has been on areas where agencies, regulators have overstepped the bounds of the law. And I think that that is something where we must constantly shine a light on. And again, as somebody who's been critical of that in the past, I believe I have a double responsibility to be consistent with the criticisms I have raised of other regulators and live within those very criticisms. I also want to talk about, before I get into the details of what we're doing at FHA, and remind you that we do, in my opinion, in many parts of America, face an affordability crisis. But as the Regulatory Transparency Project focuses on, this housing affordability crisis is more often than not the result of state and local regulations that limit the ability to build. And again, looking at what we can do to increase affordability, we have to recognize it's not just the labor market, the loan market, the housing market, it's all of these things. I use my 3 L's, land, labor, loans. And again, remembering that at the local level, the difficulty of getting permitting, the restrictive land use, all of these things reduce the supply of housing across America. And to me, I think a focus on that is an important part of the regulatory aspect. And you can look at this in a number of places. I mean, I don't want to necessarily sound like I'm picking on California, but that's a pretty good example of probably how not to run your housing market. I think you can just look at the increase in homelessness and housing in California. In fact, over the last couple of years, homelessness in Berkeley has increased 40%. I think the interesting thing is, if it wasn't for California over the last several years, homelessness would have declined nationally. And I do think that the regulatory system there has added to that in such a way that has added a tremendous amount of costs. I also think it's important to keep in mind that when we focus on questions of affordability at FHFA, we recognize that if you don't fix the land use issues, if you don't fix the labor issues, that solely via underwriting, you will not fix the problem. And in fact, you may make it worse without fixing all the other elements of it. But again, back to the topic, because as much as I would love to talk for hours about land use supply, I'm going to turn to the topic that we're here today, which is what is the future of Fannie and Freddie housing finance reform? I will note this is a question that we could have talked at any time, probably during the last 20, 30 years. Certainly was quite topical even before conservatorship. But I think it's important to recognize that I believe that we are at a real inflection point in that debate. Somehow over time, the power of the status quo got embedded, and I think it's fair to say that if you had asked this question a year ago what the future of Fannie and Freddie was, you might have just said endless conservatorship. And I think it's important to keep in mind, and if there's anything you take away today, it's that we have turned the corner. The future of Fannie and Freddie, in my view, is back to being consistent with what the statute obligates me to do. Let me also emphasize, I really do appreciate the work that Secretary Mnuchin and Secretary Carson have done in their comprehensive roadmap on housing finance reform. Let me say, I think that that is fully consistent with what we've been doing for 8 months and what we'll continue to do. And I really do want to emphasize as well, it's not only a moment of that's returning the path back to what the statute confirms, but I really do want to emphasize that to me, the time for reform that is most effective is when we are in a strong housing market. So if I can quote President Kennedy, for instance, the time to repair the roof is when the sun is shining. I say that recognizing maybe we have a little rain outside today, but I do think that this is the time when we really do want to put a strong foundation under the housing market. I often say as an economist that I'm a really big fan of meteorologists. And the reason why is because they make economists look like good forecasters. And I say this with the modesty of, I'm not predicting a downturn in the housing market, but if I can maybe perhaps channel the nationals, I think this housing market is really in maybe the 8th or 9th inning, certainly not the 2nd or 3rd. I would be delighted if this housing market goes into extra innings, but I do think as a regulator, my approach really has to be that while I hope for the best, I have to plan for the worst, and I think that's the appropriate approach for any safety and soundness regulator. And so again, trying to make sure that the housing market and the mortgage market is ready for a turn in the cycle, to me, is absolutely crucial. I'll remind you that fundamentally what got us in trouble last time was the combination of poor mortgage quality combined with insufficient capital, very high leverage on the part of Fannie and Freddie and other market participants. And sadly, the truth is that's kind of unresolved today. And I'm going to go into a little bit more detail of why I don't see us, in terms of the GSEs, in a much stronger position than we were in, 2006. I'll remind you that Fannie and Freddie have about $2.6 trillion in single-family, multifamily debt. And remind you that when I came in the door, let's just round that up and just for the sake of math, say $6 trillion. When I came in the door, $6 trillion in liabilities was backed by $6 billion in capital. You don't have to have a PhD in economics to figure out that's 1,000 to 1 leverage. You also don't have to have a PhD in economics to figure out no institution leverage 1,000 to 1 will survive or turn in the cycle. No, it's guaranteed to fail. Thanks to the changes in the share agreements that I've worked out with Secretary Mnuchin, we've started to retain capital. So I'm delighted to say that in my 8 months, we've essentially tripled capital at Fannie and Freddie. So they're only leveraged 300 to 1 today. So still much more leveraged than they should be, but progress moving in the right direction. And that's the important part of this. I'll say, by way of comparison, again, reminding you that Fannie and Freddie are leveraged approximately 300 to 1, that our largest SIFIs, of which SIFI banks that we hear so much concern about, are leveraged about 10 to 1. So, take your largest banks, and we occasionally, I think here in Washington, expresses of concern about the leverage of our largest banks, which I think is a very legitimate question to be raised. Take that leverage and multiply it by 30. And then you start to get the neighborhood where Fannie and Freddie are. So I would simply submit that anybody who is concerned about the leverage of our largest banks should be even more concerned about the leverage at Fannie and Freddie. They are far more riskier and obviously not as diversified as our largest banks. And so I also worry, that's the capital side of the balance sheet, of course. As we know, the asset side of the balance sheet is equally important. And to give you some indication, I believe the quality of the book and the quality of acquisitions in recent years is troubling in my mind, even absent the amount of leverage we're talking about. So while, of course, a lot of focus has been on borrower credit scores, which have improved and are better than they were pre-crisis at the agencies, I'll remind you that among 2019 enterprise loan acquisitions, about 20% of those have a down payment of 5% or less. That's nearly double the rate we witnessed in 2004. Also remind you the 2018 acquisitions, nearly a third had debt-to-income ratios greater than 43%, significantly higher than where we were in 2004. So to put that in comparison, if you look at LTV, you look at DTI, the book of business that Fannie and Freddie have been doing in recent years is significantly higher, riskier than it was even before the crisis, with the only offset that, again, borrower credit has improved in that case. Of course, the counter that one might hear is, well, delinquency rates are low today. Of course they are low today. I'll also remind everybody that delinquency rates were low in 2004. In fact, they were low well into the beginning of 2008. If you're going to believe that, if you're going to look at delinquency rates as a leading indicator of financial stress, you're going to be years behind the curve. You will have a crisis on top of you before you recognize it. So again, it's important to recognize that the very low delinquency rates that we see today are largely a reflection of a very strong labor market and a strong housing market. They are not a reflection of underlying loan quality by and large. And so we do need to recognize that if there is a turn in the cycle, Fannie and Freddie do not have the capital to withstand that downturn. So let me be crystal clear so that there's no risk of misinterpretation. In their current condition today, were we to see a modest decline in the housing market, the 100% chance that Fannie and Freddie will fail. This isn't an even remote possibility, it is a guaranteed, and that's not even an implied guarantee, that's an explicit guarantee. They'll fail in their current condition. Of course, I'm working toward trying to avoid that consequence, trying to build up capital, trying to get them out of conservatorship. Let me also note that one of the important reasons to get them out of conservatorship is that over time, the conservatorship, in my opinion, has meant that it's made them more politicized, where decisions at these enterprises over time have become more a reflection of politics than of good economics and good finance. And so while I occasionally hear a suggestion of, well, what's the concern? They're under government control. You know, I would say, well, if you were defining under government control as synonymous with safe and sound, I think you might want to re-examine that premise. And so again, I would really emphasize getting Fannie and Freddie to a point where they can exit, where they can be stronger, where they can withstand a downturn is my primary objective. Of course, I'd like to say modestly that I think any financial regulator should have the objective of that the institutions they regulate not fail in a downturn. I think that's a pretty reasonable objective for a financial regulator to have. I think you will see this reflected in the scorecard that we put out recently. And to give you some sense of I decided to focus on three core elements of the scorecard. The first is the focus on fostering a competitive, liquid, efficient, resilient national mortgage market so that we can have a strong marketplace. The second objective is that Fannie and Freddie operate in a sound, safe and sound manner that's appropriate for conservatorship. And it was certainly my concern that as conservatorship went on and on over time, that there was a less and less recognition that they were in conservatorship and back to normal that I think is very troubling. So I think it's important to remind ourselves pretty regularly, conservatorship is an administrative bankruptcy. There's a certain set of behaviors that you would expect from firms in bankruptcy that you would not expect from firms outside of bankruptcy. And an important part of the scorecard is reminding stakeholders, reminding Fannie and Freddie that they are indeed bankrupt firms and should behave appropriately. And lastly, to prepare for the exit out of conservatorship. I think we've made a number of advances in this time. I really want to emphasize one of the reasons that Congress took the previous regulators of FAO and the Finance Board and combined them is that Congress wanted the regulator to have a broad perspective on the mortgage market, not simply a narrow focus on any one or two set of institutions. And so it's incredibly important to me that I make sure that everything I bring to this as a top-line objective is how do I help create a more efficient, competitive mortgage market, and where do Fannie and Freddie fit in the middle of that? So let me mention a couple of activities that have been going on in that respect. Back in September, released new multifamily caps for the enterprises. And to me, I believe this was done in such a balance that would keep Fannie and Freddie from further crowding out private capital, but do so in a way that would minimize disruptions. Also, I would note that we eliminated a number of loopholes. There were exclusions to the caps that became larger than the caps themselves. So I thought it was important to roll everything back under the caps and also further focus Fannie and Freddie on their affordable housing mission. Let me also emphasize that under the new caps, they're required to do 37.5% of that would be affordable. Let me emphasize that's about 10% more than what they were doing in affordable. I am committed and believe that they can do this in a way that will not encourage irresponsible behavior, but will keep them focused on the products that they should be focused on. Instead of, I know for those of you who are residents of the District of Columbia like myself, I'm always amazed when I say wander around U Street or 14th Street and I see what looks like a luxury condo to me, and I see some like either FHA or Fannie and Freddie sign. I'm like, I don't know, is this really, and again, I appreciate my neighborhood becoming a little nicer, but at the end of the day, you have to ask yourself, is this really what their mission is to be funding high-end luxury condos? And again, making sure that the emphasis of what Fannie and Freddie is doing in the multifamily space is not crowding out private capital and remaining focused on the affordable mission, I think is incredibly important. Let me also note back in September that we prohibited the enterprises from giving volume-based variances and exceptions. And so I was under the impression and told pretty regularly when I came in that pricing was uniform across lenders and did not discriminate by price, by volume rather, or size of the lender. And so while that was largely true, I was disappointed to learn that while you had a price here that looked the same, there were all sorts of exceptions to that for individual lenders. And so one of the objectives here in trying to have a competitive mortgage market is leveling the playing field between small lenders, lenders of all size, and fostering fair competition. I mean, for instance, one of the things that I found a little bit surprising for entities that in conservatorship was that one of the enterprises up until a few months ago actually evaluated its executives based on market share targets, which again, that might be appropriate for firms not in bankruptcy, but if you're in bankruptcy, being obsessed with what your market share just doesn't seem to be, to me, the right focus. So we changed that. And we will continue to change things that we think push the GSEs in the wrong direction. And again, keep them focused on exiting conservatorship. Let me also mention, I know many of you are familiar with the qualified mortgage standard, and of course, the responsibility for changing that lies with my friends at the CFPB. But I think it's important, and we've offered to the CFPB to provide technical support and any guidance we can have, data that can be done by Fannie and Freddie, so we can test what we've seen performance of certain loans, particularly if those are high DTI, so that we can help support CFPB have a orderly transition away from the QM patch. You know, and let me say, you know, very strongly in my view, going back to where I started the conversation being about an Article 1 guy, I'll remind folks that the QM patch itself has zero basis in statute. Congress debated excluding Fannie and Freddie from the QM, and Congress rejected excluding Fannie and Freddie from the QM. So I think it's important that the QM become more consistent with the law. I would also say, at least my interpretation of some of the viewpoints of the Federalist Society is that we believe in equality under the law. And so to me, having the two largest commercial players in the mortgage market exempt from the very consumer protections that are supposed to guide the mortgage market seems at odds with believing in an equality under the law approach. So again, to me, I think it makes no more sense to have a Fannie patch than it would to have a Wells or a City patch. None of these things are consistent with same rules facing everybody. So again, I will say as an aside, it's actually quite easy to be a regulator when you have a consistent set of principles that you can follow and guide. And that's, of course, why I carry my pocket constitution with me. So let me say, that's a big part of where we're trying to level the playing field. We want to make sure that Fannie and Freddie are successful not because they play by a lower set of rules than everybody else, but because they have good execution, good management, and a good business model. And that's what we're trying to guide toward and pull them away from where they can operate simply because they don't have to play by the same rules as everybody else. Let me also say, and again, I take this as a foundational element of good risk management, which is the risk you take on the asset side of your balance sheet should be somewhat, if not completely, related to the amount of capital you have on the liability of your side of your balance sheet to absorb that risk. I think it's fair to say today that Fannie and Freddie take risks on their asset side of their balance sheet that are far in excess of that is supported by the capital that they possess. And again, I believe it is a foundational principle of good risk management and good financial regulation that your risk and your capital are directly related. And so while we'll be raising capital on one side of the balance sheet, we will be better aligning risk on the other side of the balance sheet. course, I recognize that some of my friends might believe we're not moving quickly enough in that regard, but I do believe that if we can do this in a way that will be not disruptive to the mortgage market, that it will be more durable, that it will stick, and I think we'll continue to have a very big focus on doing this in a way where it is commiserate with that kind of risk. And to give you some indication of that, we've already tried to take some steps in this regard. So for instance, the 2019 acquisitions through September, compared to last year, where we had high DTI, about a third of the acquisitions were DTI over 43, we've gotten that down to about a fourth. So again, incremental steps that move the market in the right direction. I believe Ed's metric of risk shows improvement in the GSE risk profile. So perhaps we'll talk about that in the next panel. But again, I will also note for those who might be skeptical of the impact of that, I would challenge you to find anybody in the mortgage market who thinks that the mortgage market has been disrupted in the last 8 months. And in fact, when I checked this morning, despite the modest changes that we've made in reducing leverage, reducing DTI, I believe homeownership rates actually increased over that time. That's not meant to be a forecast, but it is meant to be, I think there is a way where we can modestly reduce risk without disruption to the overall mortgage market in dealing with those worst tail risks that do so in a safe and sound manner. Again, trying to make sure that we are dealing with these issues that drive default. Another metric that I often look at, and I think it's fair to say, certainly my view as an economist who spent about a quarter of a decade looking at mortgage markets, is fundamentally you can look at three factors: borrower credit, LTV, DTI. I'm not saying other things don't matter, but those three factors cover a lot of it, particularly credit and LTV. And so the GSEs have historically done some small percentage of their business where all of these multiple risk factors were in place, so that you had high DTI, high LTV, low FICO. And so what we've been able to do in the 8 months I've been there is the percent of the business that is multiple risk factors has been cut in half. I will certainly say it was always single digits, but again, when you're 300-to-1 leverage, it doesn't take a lot of loans going bad to sink you. And so I would say we've seen significant reductions in the tail risks at the GSEs. And again, I would emphasize in a way that I don't think has had any detrimental impact on the mortgage market overall. So again, trying to see those changes, making sure that the enterprises can adjust. And let me also emphasize, we do know that one of the things that was really devastating for families was getting mortgages at the top of the last cycle where they were high DTIs, very little equity, low credit. And so again, I think it's important, and my perspective on the homeownership mission of Fannie and Freddie is that homeownership has to be sustainable. We are not doing anybody a favor getting them in highly leveraged at the top of the cycle where they don't survive a downturn. And so again, I'll say as an aside, one of the things I did was probably maybe the less enjoyable aspects of being on the banking committee during the crisis was I repeatedly got phone calls from families asking me to stop the foreclosure auction on their home the next day. And I can tell you, those are heartbreaking calls to have. And I'm committed that I don't want to have those calls again. I want to make sure that the next downturn, we have families in a position where they will weather the downturn and not be put through what they were put through in the last cycle. And let us not be under any confusion. Those families went through that crisis because we got them into highly leveraged loans that were not sustainable. And so I am committed to making sure that the home ownership opportunities provided by Fannie and Freddie are not simply sustainable for the taxpayer, for the economy, but are sustainable for the borrower. And fortunately, I think all of those things are in alignment if we do it the right way. And so again, I think we can do this in a way that is responsible. Let me also mention one of the additional directions of alignment, and Dr. Carson talks about this in the HUD report, is how do we better align Fannie and Freddie and FHA? I think it's fair to say that one of the things that got Fannie and Freddie in trouble pre-crisis was aggressively competing with FHA for market share. Personally, I believe when you have two entities with an implied guarantee and another entity with an explicit guarantee all vigorously competing with business, the real loser in that process is going to be the taxpayer and financial stability at the end of the day. And I would also say that to the degree that, as we saw before the crisis, where Fannie and Freddie come in and essentially skim the top credit quality away from FHA, this lowers the average credit quality at FHA and forces premiums up. So I'm just simply trying to make sure as we move forward that Fannie and Freddie are not threatening the viability of FHA. And again, if that means that some business goes to FHA, that's fine. Because again, I do think it's possible where a sliver of business can go from the GSEs, go to FHA, and at the same time improve the credit quality at both the GSEs and FHA. And we'll make FHA a little more sustainable and leaving that risk on the side. Certainly not here to talk about FHA today, since that is Dr. Carson's purview. But I think a number of reasonable suggestions were put forth that will also better align the risk that we see at FHA as well. And I'm certainly concerned in the extent that FHA drives down credit quality standards in the market, it obviously impacts the entities that I regulate. So again, trying to work together where we have better alignment. I guess I say better alignment on 7th Street, since they're on one side and I'm on the other. But let me just end with wrapping up and emphasizing a few details, a few themes here again, which is on the liability side of the balance sheet, we'll continue to build capital. I think that's incredibly important. And my objective, of course, is to try to make sure that any downturn, that there is no call upon taxpayer funds, but that Fannie and Freddie instead have capital on their balance sheet that can absorb losses. I think it's also important, however, to make sure that if that capital is sufficient, that we must continue to move the risk-taking to be better aligned with that capital. Again, the objective is to make sure that Fannie and Freddie have a book of loans that performs during a crisis. I'll continue to work with Secretary Mnuchin on changes to the PSPA in months ahead. Obviously, one of the really big, important parts of building capital is getting the capital rule right. I know as many of you are perhaps aware, we announced that we will repropose the capital rule. My target is sometime early in the first quarter. But let me emphasize the primary reason for this is I believe that fundamentally when the capital rule was initially put out in June of 2018, that the underlying assumptions behind the capital rule were largely that Fannie and Freddie would not be building capital. So I certainly scratched my head when it first came out and said, well, what's the prospect for building capital? So I think that since the fundamental assumptions behind the rule have changed, that it's only appropriate, and I think especially given a venue where we emphasize regulatory transparency, that the most transparent thing I can do is put a rule back out to gather commentary. I would also note a number of other issues were raised during the rulemaking process by a handful of commentators that I think it was important to get other commentators to reflect upon. So for instance, Fannie and Freddie themselves raised questions about whether the rule was overly pro-cyclical. I will note all of the entities I regulate, not just Fannie, Freddie, and the Federal Home Loan Banks, I think are uniquely different from commercial banks in one important aspect, and several important aspects, but the most important of which is depositories are almost by their very nature inherently pro-cyclical. The very purpose of Fannie, Freddie, and the Federal Home Loan Banks is to be counter-cyclical. And my belief is they have been a little too pro-cyclical in the past. So I think it's critical as we repropose the capital rule that how do we make sure that we're having a capital rule that is counter-cyclical rather than pro-cyclical. And that's one of the topics that we will be looking for additional comment on as we put the rule back out. And again, making sure we're doing this in the right way. But I really want to emphasize, since it was the leverage and lack of capital that caused Fannie and Freddie to fail, that in my view, this may perhaps be the most important rule I do during my tenure. And so it's important to me that it's done in a transparent manner, that we hear from stakeholders, and that we get capital where it needs to be to protect Fannie and Freddie from an additional downturn. So I think that's just an important part of it and how we need to fix that. I am optimistic that we can get there. Let me last end with the observation. The Federalist Society was created in 1982. I think it's fair to say, I'm not sure if Peter was around at that founding or not, but let me say, probably part of that effort. But I think if you look at, to me, the Federalist Society over that time, you talk about the odds being against you, trying to shift the conversation at that time in legal academia. I'm sure there was somebody in the room who said, you know, this is worse than Atlas rolling the boulder up the hill. You must have, you talk about fighting the odds. And so I would say, given how much change we've seen the Federalist Society and the real successes at fundamentally changing the legal debate in this conversation in America and the impact it's had on the judiciary and otherwise, that I take a lot of hope from that. What I take away from that is you can be outnumbered, But if you've got logic, you've got reason, you've got the Constitution on your side, I think there's a lot you can accomplish. So every day when I feel like it might be a little bit harder to get Fannie and Freddie where they need to be, I take inspiration by what the Federalist Society has achieved. And I look at that as kind of my bar. So I'm not going to get there, but I appreciate everything that's been done, and it really is a lesson that if you keep pushing, keep fighting, you can get there over time. So really appreciate, again, I don't want to hold up my Rolling Stones panel from coming up, so I'll let them take the stage. Thank you for your time and attention.
All right, well, if like me, you've ever bemoaned the lack of principled leadership in Washington, you just got a chance to see it. So that's a real privilege, and I think we're lucky to have the director in government at this time in the right place at the right time. So now let me introduce my friend Alex Pollock, who's going to serve as the moderator for our next panel, and he will introduce our distinguished panelists who have, I don't think it's an exaggeration to say, led the conversation in housing policy since before I came to Washington. Alex Pollock served a distinguished career as the CEO of the Federal Home Loan Bank of Chicago. I knew Alex when he was at AEI and then at R Street as a leading scholar and author of books and op-eds and articles, more than I can count, and across a wide variety of policy areas. So he was helpful to me when I served in the House of Representatives on Federal Reserve oversight issues and Federal Reserve reform issues. He's been a leader in that conversation on housing policy and spanning across the financial market spectrum. And he's now, talk about right place at the right time, he's now the Deputy Director of the Office of Financial Research at the Treasury Department. And so we're really lucky to have him here to moderate today's panel and conversation. Please join me in welcoming Alex.
Thanks very much, and thanks to the Federalist Society for organizing this obviously important and timely event. Ladies and gentlemen, good afternoon. We have two panelists here and one who will participate in absentia through me. They can react to Director Calabria's comments or present their own views in whatever mix they would like. And now being with the Office of Financial Research, I, of course, have to say that any questions I may ask as moderator are my own questions and not those of the U.S. Treasury Department. We have a distinguished and truly expert panel, as J.W. said, and let me say a few brief words in introduction in the order of their opening remarks. Ed Pinto will speak first as a resident fellow and the director of the AEI Housing Center at the American Enterprise Institute, where he looks at a lot of things in really creative, deeply analytical ways, but among them, importantly, are the current house price boom that's been running since 2012. In his misspent youth, Ed was executive vice president and chief executive officer for Fannie Mae, over on the dark side, perhaps before they came, perhaps they became quite so much the dark side. Mark Zandi, who's unfortunately not here because of a health emergency in his family, but he's been kind enough to provide us a set of comments, which I will read on his behalf. In second place, Mark is the chief economist at Moody's Analytics and a director of MGIC, the nation's largest private mortgage insurance company, and the lead director of the Reinvestment Fund. And then we will have Peter Wallison, who is a senior fellow and holds the Arthur F. Burns Chair in Financial Policy Studies at AEI, among many other things. In his career, he was general counsel of the United States Treasury and White House counsel to President Reagan. He's the author of many books, but for today, particularly relevant, is hidden in plain sight what caused the worst financial crisis and why it could happen again. And we know, of course, that playing leading roles in that book are the very entities we're talking about today, Fannie Mae and Freddie Mac. After opening comments from all three participants, we're going to give Ed and Peter a chance to respond to other comments or clarify thoughts if they wish. We'll then open the floor to your questions. We're going to adjourn promptly at 2 o'clock unless you run out of questions before that. And with that, Ed, you have the floor. Thanks.
Thank you, Alex, and thank you to the Federalist Society for the opportunity to speak here. I'd be remiss if I didn't mention that this is actually an opportunity to bring what was affectionately known at AEI when Alex and Peter and I all worked there side by side in offices as the three amigos. And the senior amigo and the amigo, and I was the tea boy. I got to carry the tea and do other things because I was the youngest by far of the amigos. What I'd like to do, a couple things. One is talk a little bit about my view on the true stockholders in the GSEs. Secondly, talk about housing finance reform, many of the items that Mark mentioned, and in particular talk about how to track what's going on there from a transparent perspective, which I know is something near and dear to this group. So starting with the shareholders or stockholders, in my opinion, the taxpayers are in fact the true stockholders. Why are they the true stockholders? Emblazoned on every single share of stock, every single share of debt, mortgage-backed security says these securities are not backed by the taxpayer or the federal government. The owners of those securities had no expectation of getting bailed out. Legally, they had an expectation from a matter of practice, but as a matter of legal consequence, they had no such right or expectation. So the taxpayers have a right to expect that any plan that recapitalizes the GSEs and allows them to exit conservatorships takes into account a number of key principles. Principle one, if the dividend sweep, which is the one that allows all of the dividends to be swept to Treasury, save the bit that's going into capital today, were to be reversed and go back to the 10% dividend that was in place before the sweep was put in place, then that 10% dividend should be recalculated retroactively to that point, and you figure out what that amount should be. And it's a quite sizable amount because it was 10% on the outstanding stock, which is something like $180 billion. So it started out at roughly $18 billion a year, and you'd figure all that out. Secondly, since the conservatorship in 2008, the Treasury has waived the periodic commitment fee that's provided for in the senior preferred stock purchase agreement starting on day one. They've been waiving that fee for the entire period, which is now running 12 years. That fee on $6 trillion, as Mark indicated, in outstandings is something about $8 or $9 billion a year at a nominal 16 basis points, which my colleague or former colleague Alex has calculated based on some FDIC premia, and it would be 16 or 18 basis points. And so that's, again, a sizable sum and hasn't been paid for a total of 12 years. Then that periodic commitment fee should be paid on an ongoing basis into the future because that's what keeps the GSEs able to sell anything into the private sector. Through the preferred stock purchase agreement. And by the way, the 10% dividend should be paid going into the future to the extent that those stock amounts are still outstanding. Third, prior to the release from conservatorship, each would need to meet levels of capital that appropriately reflect the risk of loss. And again, Alex has written about this in his past roles, about what that might be. As well as the cost of capital allocated to similar assets held by regulated financial institutions. This would include some appropriate too-big-to-fail capital requirement as buffers, Again, given these $6 trillion entities, each of which is larger than the largest financial institutions otherwise in the United States. And then lastly, there should be full recognition of the value of the taxpayers' warrants. The taxpayers have warrants for 79.9% of the outstanding common stock that they can exercise, Treasury can exercise at any time, and that would give them 80% interest. And it's only after all these are taken into account that you then begin to start talking about the rights of the junior preferred stock shareholders and the common stock shareholders. It's only after you go through all these things, in my opinion. Mark spoke quite a bit about housing finance reform, the Treasurer's report from September that outlined a number of steps. And one of the things that was in that report was pending legislation. FHFA should assess whether each of the current products, services, and other single-family activities are consistent with its statutory mission and should continue to benefit from support under the Treasury's preferred stock purchase agreement. Again, in some respect, Treasury could say you can't do any business because that's just too risky. The taxpayer is on the hook for all of this. But certainly they could say you don't do vacation loans, so they actually say, and in particular, FHFA should solicit information on whether to tailor support for cash-out refinancings. Has nothing to do with buying a home. Investor loans, again, has nothing to do with someone buying a home. Vacation homes, higher principal balance loans, and other subsets of GSE-acquired loans. These are all statements in the report to the President. The GSEs, in my opinion, the GSE's core mission should be to assist low and moderate income home buyers in acquiring a primary residence. And as we'll see, more than half of the business today, probably well over 2/3, has nothing to do with helping low and moderate income home buyers acquire a primary residence. So from an interest of transparency, the Housing Center has been tracking, Mark alluded to this, has been tracking the business of the GSEs along with FHA and the VA and rural housing for over 6 years now. And we publish a mortgage risk index and many other indices. And we use those reports to track and indices to track what's going on so that we can evaluate whether they're actually shrinking their risk, which again, Mark alluded to in a couple of instances, and what kind of risk they will be to the taxpayers. In my opinion, these $6 trillion entities on a combined basis will always be a risk to the taxpayer no matter what Congress tries to do to alleviate that risk. The only way to alleviate that risk is to shrink them enough so they're no longer systemically important financial institutions, full stop. Otherwise, they will always be a risk to the taxpayer. And it's worth noting that the two financial crises that we've had in the last 25 years, 25 to 30 years, one in 1989 with FSLIC and the savings and loan industry, and 2008 with Fannie and Freddie, were both based on housing and mortgages, and they were the two biggest bailouts that we've had for the taxpayer. And that will happen again unless we fundamentally change the approach to the GSEs. Mark mentioned that he keeps a constitution on his person. When I was at Fannie Mae back in the mid-'80s, I kept their charter, the Fannie Mae charter, in my desk drawer, and it was a paper copy, and I would pull it out and look at it periodically. And I actually would read this one sentence, or a couple sentences. The operations of Fannie Mae under this section, which is the whole operations of Fannie Mae, shall be confined so far as practicable to mortgages which are deemed by the corporation to be of such quality, type, and class as to meet generally the purchase standards imposed by private institutional mortgage investors, read banks and other portfolio lenders. In the interest of assuring sound operation, the prices to be paid by the corporation should be established within a range of market prices for a particular class of mortgages involved. Third, the volume of the corporation's purchases and the establishment of purchase prices, sales prices, and charges and fees should be effected only at such prices and on such terms as will reasonably prevent excessive use of the corporation's facilities. Those are quotes directly from the charter today and from 1985, same language. Needless to say, Fannie Mae, in my opinion, has been prima facie violations of that charter for decades. Most recently, we did a study comparing the GSE loans up near the top of their loan limit and the private loans that occur just above that loan limit. And what we found was that the Fannie standards were much looser right at the top than the standards of the private sector above that. Well, why is that? Well, Fannie's trying to get these loans. Actually, the private sector has lower rates on those loans than Fannie does. Well, how does Fannie get the business? Well, they do it by giving much looser underwriting standards. So lower FICOs, higher debt-to-income ratios, lower down payments. Again, this doesn't seem to comply with the statutory language I just read. Moving to the specific items that we're tracking in order to have complete transparency, Mark mentioned about the loans greater than 43%. They have been coming down, but they've been coming down from an extraordinarily high level, and a level that was pushed up dramatically in mid-2017 at the behest of Mark's predecessor, the FHFA director, Mel Watt. He ordered them to expand their DTIs, and so they went from about 15% of the loans being for Fannie Mae being above 43% debt-to-income ratio to over 30% in a matter of a little over a year. It was a very dramatic change. Yes, it's come back down from about 31% for Fannie to about 25%, but it's still nowhere close to the 10%. We track this both in the past. We also look at what's the trend line. And some of you may know that the patch is set to expire in January 2021, a little over about 13 months from now. And so we track the trend line, and we think that at the current trend, they could get to zero by about January 2022, and if they accelerate slightly, they can meet the trend line or meet the date of January 2021. So this is all feasible. I'll talk about the impact on the market in a minute, but it's certainly feasible to do this. The housing lobby, of course, would say that that's completely impossible to do, but they're starting to do it. They're making progress, but they have a long way to go. Mark mentioned about GSE purchase loans with a combined loan to value above 95%. Again, this was a policy change that was made at the behest of Fannie and Freddie's regulator back in 2013. Fannie and Freddie had gotten down to a point where their loans over 95 were rounding to a very low percentage. Freddie was almost at zero, and Fannie was down around 4%. That was pushed up in Fannie's case to 19% as recently as earlier this year, and in the case of Freddie, about 9%. Those have been coming down, again, very slowly, but from these very high levels. So Fannie's gone from 19% to a little under 14% progress, but we have a long way to go to get down to 3 or 4%, which is where they were before they were ordered by their regulator in 2013 to change the path. How many minutes?
1 minute warning.
1 minute warning, okay. Risk layering, Mark mentioned risk layering, and yes, Fannie's case, there was 8% risk layering, which meant that you had a number of risk factors present. That's gone down to about 3.5%. Freddie's quite a bit below that. When I was at Fannie Mae back in 1985, there was a saying, Fannie Mae, but Freddie won't. And that still seems to be the case. De-risking, we suggest that the way to really track what's going on here is to look at de-risking the GSE loans based on our mortgage risk index. We call a loan above 12 a high-risk loan, and today about half of those high-risk loans are purchase loans, about a quarter are cash-out refis, and about a quarter are no cash-out refis. We think those loans could be eliminated. It would reduce the purchase footprint by about 20%. It would reduce cash-out by about 28%, and the no cash-out by about 27%. This is a way to very easily de-risk the GSEs by reducing these high-risk loans. And so we think that's something that, again, we track every month. And I am done.
That was a good concluding thought. Let me turn to the comments which we have from Mark Zandi, and these are his written comments, which I will read on his behalf. Mark says, "The Treasury and the FHFA's administrative reform plan for the GSEs has the laudable goal of reducing the dominance of the GSEs, GSEs obviously meaning Fannie and Freddie, while maintaining broad access to mortgage credit. But, he says, the plan will almost surely fail. As the GSEs currently retain only a small amount of credit risk, they're transferring most of the risk to private mortgage insurers and credit risk transfer investors. The only way in which the FHFA might meaningfully reduce the GSE's dominance is by reducing their mortgage origination footprint." That's what you just heard from Ed, that they should. However, the GSE's main advantage in the origination market is not their capital and regulatory treatment, as proffered by Treasury, but the federal government's backstop of the institutions. And that backstop must be maintained to ensure that the long-term fixed-rate, prepayable mortgages remain the mainstay of the mortgage market. It is a reasonable debate whether it is good public policy to support this type of mortgage, but it is a political reality. Reducing the GSE's origination footprint would also jeopardize their ability to provide the cross-subsidy necessary to maintain broad access. Treasury is understandably critical of the affordability regime in place today and proposes a fee on guarantors to replace it. Although this restructuring of the affordability regime makes a great deal of sense, whether it can make up for the significant hit in cross-subsidy the system will take under the administration's reform plan depends on how and how much it reduces Fannie and Freddie's footprint, how high the affordability fee is, and how effectively its revenues are allocated. However, none of this is possible with administrative reform, as the fee and the overhaul of the affordability regime would both require action by Congress, which is not likely. The Treasury reform plan also envisages recapping and reprivatizing Fannie and Freddie, but the Treasury's efforts to reduce the dominance of Fannie and Freddie would make this difficult, perhaps impossible, to attract the private investment needed to get Fannie and Freddie out of conservatorship. Given all this, Mark concludes, the GSEs seem likely to remain under government control for the foreseeable future. The GSE conservatorship is far from ideal, but the housing finance system is currently working well. Taxpayer exposure to mortgage credit risk has been reduced, and the key political constituencies, including small lenders and underserved communities, are generally happy with the system. Thanks again, says Mark. And Mark, thank you for getting us those comments, and we're sorry you can't be with us. With that, let's go on to Peter.
Okay, thank you very much, Alex. This is working, right? I must say that Mark, when he was talking to the Federalist Society, emphasized something about the administration's policies that he doesn't usually emphasize, and that is that he wants to reduce their risk, which is fine and laudable, and he wants to have enough capital so that if they should fail, it's the taxpayers. It's not the taxpayers' cost, it's the shareholders' cost, all of which makes a great deal of sense. The trouble is that the administration's policy would not actually end up in that way. I wrote an article about this several months ago, and I said this, after the administration's policy came out, and I said, this is a very comprehensive policy description which was missing only one thing, a reason to do it. And Mark outlined the only sensible thing to do, of course, which is to reduce their risk to the taxpayers. But unfortunately, I don't think it can be done the way the administration has proposed. One of the central questions about the administration's plan is why they want to preserve these two companies. This is never answered, and it is very difficult to answer other than to say, if we can reduce their risks substantially and then eliminate them, that would make some sense. But the way the administration is proposing to do it does not work. We just heard that the plan is to recapitalize them and eventually release them from the conservatorship. Is it possible, what the administration believes, is it possible that the housing market cannot function without them, and that's why they are being preserved? This seems highly implausible to me. The U.S., which is supposed to be a free market country, is the only developed country that has a housing finance market dominated by the government. Every other large U.S. consumer market, autos, food, for example, is run by the private sector. And all of these markets have run smoothly since the 1930s. These are also markets with stable prices over the years. Food is now actually a smaller cost to families than it was many years ago. And auto prices, in terms of family median income, have remained stable since the end of World War II, even though cars have substantially improved. Maybe most important of all, these are not markets that have ever been the source of a financial crisis or are regularly characterized by booms and busts. So why is the government involved in the housing market at all? So if the GSEs are not necessary to sustain housing finance, why does the administration want to recapitalize them and release them? Why not just gradually close them down? There can be only one reason, at least as far as I can see, and that is the administration must believe that Fannie and Freddie are necessary to subsidize lower housing costs and thus increase home ownership. As a shareholder-owned, fully capitalized company, however, each of them would be expected to do this. The administration says that as recapitalized firms, their risk will be borne by the shareholders and not the taxpayers. But how does a fully capitalized, shareholder-owned company whose risks are borne by the shareholders subsidize the housing finance market? One possibility might be that Fannie and Freddie will retain some government backing when they are released from the conservatorship. Now, Mark Zandi is completely correct that there's unlikely to be any action by Congress. So the government backing that they have today is about $240 billion in funds originally appropriated to the Treasury for their bailout and never used, and that has been sort of seen as a backup for Fannie and Freddie, and perhaps they are to be privatized with that still in existence. This subsidy might be enough, just thinking about it, might be enough to enable them to reduce the cost of their mortgages and thus spur housing. But the administration says that they will be required to pay for that backing, which of course wipes out its value as support for a housing subsidy. Once again, it is not clear how these two shareholder-owned firms will be able to offer subsidized mortgages. Perhaps then the administration's thinking is that the GSEs will be able to offer types of mortgages that ordinary private sector companies cannot offer. One candidate would be a 30-year fixed-rate mortgage, the one that is so popular with members of Congress and members of the National Association of Realtors. Because they amortize principal over 30 years, these mortgages reduce the monthly mortgage payment, allowing homeowners to bid for higher-priced homes. That's why the realtors love them. Why Congress loves them, I don't understand, except they like to do what the realtors like. However, anyone with good credit can get a 30-year fixed-rate loan from a bank. And if you don't believe this, you should look on the internet at what the banks are offering 30-year fixed-rate loans for, and you'll find that in many cases it's less than what Fannie and Freddie is requiring. So it remains very puzzling to me why anyone thinks that after recapitalization, the GSEs will be able to offer subsidized financial support for the housing market, that any private firm like a bank or a private mortgage securitization system cannot offer. If they have private shareholders, the shareholders will want profits. That's why they invested. which means the GSEs will not be able to cut their mortgage rates below those of their competition if they want to remain profitable. Yet the administration's plan says that Fannie and Freddie will have to earn less than the return on other activities when they acquire mortgages of low and moderate income families. So there it is. That's the idea that the administration appears to have in mind for subsidizing mortgages through Fannie and Freddie. So again, as unlikely as it seems, the administration expects that these two fully capitalized shareholder-owned firms, which are paying for their government backing, will be able to subsidize low and moderate income mortgages. It's hard to see how this can possibly happen. Yet, as we have heard in Director Calabria's speeches, not here, but in other statements that he has made, not to the Federalist Society, he wants the power to charter more GSEs so they will compete with Fannie and Freddie. Maybe he means to share the inevitable losses of Fannie and Freddie with more of these GSEs. Thus, it seems to me that there is only one way that they can survive and prosper after they have been released from the conservatorship, and it's exactly the opposite of what Director Calabria just suggested, and that is by taking more risk than anyone else, by reducing their underwriting standards and making riskier loans. This, ironically, has some chance of working, at least for a while. The government backing and the fact that they are too big to fail may encourage creditors to continue to lend to them no matter how much risk they take. Creditors could never, these are things that creditors would never do for a fully private firm that is functioning in a competitive market, but perhaps Fannie and Freddie will be seen differently. So rather than de-risking or preventing failure, which is a good idea, the recapitalized GSEs, as Calabria suggests, the administration would end up setting them up for more risk-taking. So where will we be, if the privatized GSEs take on more risk than anyone else? The answer is on our way to yet another government-stimulated financial crisis. Thanks very much.
Thanks, Peter. Thanks for the comments. Peter made a point which I think is very interesting about the rates on 30-year fixed-rate mortgages. If you go back in time, it used to be said the justification for Fannie and Freddie was what people usually thought of as, well, they made these mortgages 1/4% less than private lenders. That was measured by the jumbo market against Fannie and Freddie rates. And so obviously it was said, maybe isn't really so obvious, but it was said that's the justification. And now it seems to have switched. And Ed, I know in your recent conference, we had some serious discussion on this. Do you want to add maybe some comments on this unusual situation where the private market's 30-year mortgages seem to be priced at lower rates than Fannie and Freddie?
Yes, great point, Alex. So yes, there was a study done jointly with AEI, the MBA, technically FHFA, but it was Lynn Fisher when she was at AEI and then went to FHFA, that had done this study, and basically went back to 2000 and tracked what rates were at various points, the jumbo rates and the conforming rates, rate at the cusp, and how things changed over time. And then the loans were also risk adjusted, so you could compare apples to apples. And they were talking about 30-year fixed rate loans only. And as Alex said, the rates were lower back in the run-up to the financial crisis by an average of 25 basis points. But we now know that wasn't because of anything the GSEs brought to the party. It was because they were underpricing risk by 40 basis points. How do we know that? Well, their G fees are now 45 or 40 basis points higher than they were back in the early 2000s. And so if they had added that, had they priced their G fees appropriately, then they would actually have been below where the private sector was doing portfolio loans, because the funding mechanism for the private sector is completely different than the G fee structure and mortgage-backed security structure for the GSEs. So today, and since about 2014, we've had a situation where the private sector, even on a risk-adjusted basis, even on lower price loans than what Fannie and Freddie do, have had rates somewhat below Fannie and Freddie. If I might add a couple of points about what Mark Zandi mentioned. Federalist Society, to be congratulated, you got a story in the Wall Street Journal today. The title was Fannie Mae and Freddie Mac curb some loans as regulator reins in risk. So just anticipating the topic of today's keynote. But in that first sentence is the point that I'd really like to focus on. Fannie Mae and Freddie Mac are pulling back on some mortgages meant to make homeownership more affordable. And as most economists know, there's the seen, the unseen, and the foreseeable. The seen is the government says we're making things more affordable. Think about health care, think about student loans, think about housing. We're making things more affordable. That's the seen. The unseen, of course, is they actually make things less affordable. And to follow up on a simpler version of what Peter mentioned, if you'd like to know which area is which, if you could push a button and figure out how many conferences there are on affordable housing, affordable health care, affordable student loans, there are thousands of them. How many are there on affordable cell phones, affordable food, affordable clothing, affordable cars? None. Why? There's no rent seeking in those things, as Peter pointed out. The rent seeking is all in the stuff where the government is making things affordable. Mark said the mortgage market is working. Well, you have to question, and Mark Zandi, you have to question that, because what did Mark Calabria say? We're in the 8th or 9th inning of a boom. This boom started in 2012. We've been tracking it, and it's going up at virtually the precise pace as the last boom, which started in 1998. Well, how can that be? We don't have all the same kinds of mortgages and stuff, but we have plenty of leverage, as Mark talked about, led by FHA and also a portion of the GSE business. And what we know from history is that when you add that leverage in a seller's market, which we've had since 2012, it immediately gets capitalized into higher prices. So now coming to the last point, well, what did Mark talk about? Well, there won't be enough cross subsidies. What are the cross subsidies? The cross subsidies are the money taking from the good borrowers to subsidize the less good borrowers, to give them a lower rate to make it more affordable, but that gets capitalized into higher prices, so you're chasing your tail and you're creating the unsustainable price increase that we've seen yet again. So.
Thanks, Ed. Peter, picking up on what Ed just said about Mark Zandi's comments, Mark Zandi seemed to suggest that the status quo was okay, and maybe we just let it ride for a while. How do you react to that, and what would you do instead?
Well,
The Wallison program.
The Wallison program, as you could probably tell, is we should close these firms down, withdraw them from the market gradually, and let the market function without any government involvement at all. But when Mark Zandi wrote his original paper, and he sent it to me, he said, you see, we both agree, we're just coming at this from different angles. And what he meant was that under his way of thinking about it, Fannie and Freddie have to make a lot of money in order to be able to continue to subsidize the market. My question is, if they're not going to be able to make a lot of money by their operations, they are not going to be able to subsidize the market. And we don't need subsidies anyway in this market. It would function perfectly well without any kinds of government subsidies. So let's just eliminate them. Unfortunately, the administration, supposedly a deregulatory administration, has not seen fit to do something that they could easily have done administratively.
Thanks, Peter. And I would call attention to the point Ed made in the subsidy discussion, which is the subsidy turns into higher prices for the house, and then what have you gained? Ladies and gentlemen, it's time for your questions. When called on, please tell us your name and your affiliation, and then ask your question. If, when called upon, you feel a sudden urge to give a lecture, the chair will give you 60 seconds to come to your question. With that, do we have a first question? Why, what a surprise. What a surprise, Bert. And wait, Bert, wait for the, I should have mentioned, please wait for the microphone on your question.
Bert Ely, banking consultant. At a conference at George Mason a couple of months ago, Mark was speaking, and I posed this question to him. I said, Mark, my analysis of Fannie and Freddie's numbers are they don't earn enough money to justify or be able to generate a market return on the equity capital that is being proposed for them. And I said, how is that going to get resolved? And he said, well, we're going to have a few tweaks in a few months to deal with that. And I sensed that one of the tweaks might be some kind of phase-in of capital, of the full capital standard for them. Now, I'm skeptical if they would ever get to the end of the road on that. But my question is this: if in fact that's going to be part of the, shall we say, the transition plan for Fannie and Freddie to full private ownership, how are those tweaks going to play out, and particularly what might be the reaction on Capitol Hill to them?
Ed or Peter? Peter?
Let me take that, because I don't think it will get that far to actual privatization. And I'm curious to see how it will work, because what will happen, of course, is that prospective shareholders or investors will ask your questions, and maybe some of the questions that I was asking. And they'll say, well, I just don't get it. How does this firm that I'm supposed to invest in, that doesn't have full government backing for its obligations, how will that survive over the long term? And the answer is, of course, it won't. And what Mark Zandi was trying to say is, well, we don't expect it to. What we do want to happen is that they have as much opportunity as they can be given to make large profits on their operations, so that they can subsidize the mortgages that are given to probably low and moderate income borrowers. But I don't see any way that this can possibly happen. So I don't see that they can actually be privatized, and I'll be curious to see what happens as the administration begins to go to the markets and say, well, here's what we hope to be able to offer you in 2 years, and that is these two companies will be fully privatized, and they will have capital, full capitalization, and they will then operate in the markets. And the first question will be, well, why do we need them? And the second question will be, okay, if we need them, if that's what you think we need, how will they make money? And I cannot, for the life of me, understand how that will happen.
You have any further comments, Ed?
I agree with what Peter said. I think one of the sort of dirty little secrets here gets back to this cross-subsidy. So the cross-subsidy, and I think Mark came up with this number. I've heard Mark Zandi, I've heard others talk about it. It's $5 billion a year that gets shifted from lower risk borrowers to higher risk borrowers through pricing cross-subsidies of some type or stripe. Which then makes the GSEs less competitive, and so they're fighting a battle against the private sector, who's picking off better loans because they're not doing that cross-subsidy. But then you have FHA, which itself has a huge cross-subsidy machine going on, because FHA doesn't even price for risk. They have uniform pricing pretty much across the board, so their riskiest loan is priced the same as their least risky loan, because Congress doesn't want them pricing for risk. And so you have this crazy situation where you have a lot of cross-subsidies going on over here, you have a lot of cross-subsidies going on over here. Fannie and Freddie are trying to compete with FHA, and they're with all these cross-subsidies, and the community groups say, wait a minute, you can't reduce any of this because the cross-subsidies go away, and they miss the obvious, which is this is in part what's driving house prices higher, which is helping people not be able to afford homes. So that's the crazy situation we have, but Congress loves it that way.
Thank you. Another question over here?
Yes,
Wait for the microphone, please, and then tell us who you are.
My name is Richard Feen. I'd worked for Freddie Mac for a number of years, and most recently had an appointment for FHA. My question is kind of a general one. You know, FHA now, under the administration, is pushing for more condo loans for first-time home buyers. I'm just want to see your interpretation for that.
Comments? Ed?
So we're going to be tracking this with our data, but it takes a long time for these things to take place. We're probably looking a year out before we can actually get our arms around it. But my initial reaction is as follows. They made a change that said we had these condos that are not approved condos, of which most of the condos are not approved condos. And so we're going to say, okay, you can have, I don't remember the exact numbers, you can have 2 or 3 units in each condo up to 10% or a minimum of 10%, whatever, and you don't need to get this approval for that. That sounds pretty innocuous, except that they're talking about the stock is this, and it's some percentage of the stock, and over here they're talking about the flow. Well, the flow is a small percentage of the stock at any given year, and so you now get potentially a bunch of condos that are now eligible for FHA financing that weren't eligible before. Go back to Rule 1. When you add leverage, you get higher prices. And so all of a sudden, and the thing we're going to be looking for, as we do with other things, is this result in higher prices, which my guess is it will. But it's going to take us the better part of a year. We did that study when FHA lowered its premiums, and we were able to show that prices went up 3% in the areas that had high concentrations, relatively high concentration of FHA lending. But it wasn't just for the FHA borrowers. It went up for all of the borrowers because of another economic rule that says the marginal buyer sets the price. And if the marginal buyer is the one with the government subsidy in hand, they're setting the price. Think about, student loans and college education.
Thank you. Our next question is going to be one that came through the Federalist Society from a couple of its members who wanted to know what the panel thinks about the Fifth Circuit's opinions, I think the plural is right there, opinions in the Collins case, and specifically whether shareholders were or should have been deprived of their rights in these cases. Ed, I know you have some thoughts on this.
My thoughts are very general, and I'll let Peter speak on this. Again, I've already said it. In my mind, the shareholders have no right to anything until the taxpayers have been fully repaid back, as I outlined. That means that there's precious little left over, and it gets back to even more so to this question of, is there an economic return that can even be paid, to the junior preferred, but much less the common shareholders down the road? 5, 10, 15 years from now, who knows? But I think the taxpayers need to be taken care of first, and at some point, this is trying to get litigated, but at that, I'll turn that over to Peter.
Peter?
I certainly agree with your idea, and so the part of this question is on whether the shareholders should receive anything is, to my mind, nothing. However, this case, on a legal basis, is first of all, it's extremely complicated. I'm going to tell you a little bit that I know after some past reading of this case, which is called Collins versus Mnuchin. But what the problem is, this was a on-bank decision. That is, it came out in one way when it was first reviewed by the Fifth Circuit with a 3-judge panel. They concluded that I don't remember what they concluded, but I will tell you what the en-banc concluded, and that is that there was no authority in the FHA, the FHFA, that is Mark's organization, to make this agreement with Treasury. They didn't have the authority to deprive the shareholders of their rights. And they remanded the case to I guess, I don't know what happens when you remand a case from an en-banc, but I guess it goes back to the district court for further action. However, this was a case with 16 judges and divided into majorities of 8 or 9 on 3 different issues. And so it's very hard understand what the case was actually concluding. But after saying that the FHFA did not have the authority, they then said, however, the FHFA is unconstitutional because the FHFA is headed by a single director who cannot be removed by the president except for some sort of malfeasance. So the agency that didn't have the authority to make the deal with Treasury and deprive the shareholders of their rights was itself unconstitutional. So their remedy in a case like that, says one of the majorities that developed in this case, they had their remedy was a majority did hold that the shareholders can only obtain a declaration that the FHFA's structure is unconstitutional. So if this is at least how I read this case. So if you go back at it and you want to know what was actually determined by the Fifth Circuit, and you're a shareholder, you will find that you actually did not get anything from the decision of the on-bank court. Now, you might get something when it goes back to the district court, and the district court may again hold that even though the FHFA is unconstitutional, nevertheless it can make this, it could have at the time made this decision or this agreement with the Treasury, but I kind of doubt it. I think the case is sort of at an end right now, and we'll have to wait for some other cases to clarify this.
Thank you, Peter, Ned. More questions from those here present? Yes. Hi, Una.
Una MacDonald. This is intended to be a slightly mischievous question. As you know, the considerable work was done before Mark was appointed as chief executive under the previous FHFA administration to insist on a single securitization platform. And many brokers, etc., had to make sure that their IT systems conformed. So maybe in order to improve the income flow for Fannie and Freddie, the charges for the use of this platform should be raised to a very high extent. I cannot understand why a single securitized platform is required, or the alternative would be to remove the obligation to use that platform. Either way, I think one would hasten the demise of Fannie and Freddie.
Comments? Yeah.
What was the question?
Do you think the single securitization platform is necessary or desirable? That's what I take the question as.
I don't think it's necessary or desirable. As Peter said, there are other parts of the capital markets that operate just fine without it. We did when the three amigos were working on this 2 years ago, we talked to a lot of market participants, and they all said pretty much the same thing. If the footprint of Fannie and Freddie were to be shrunk tomorrow by 10%, and then another 10%, and another 10% over a couple of 3 years, the private sector would move in with a clarity. There wouldn't be much delay. All of these questions of how many angels can dance on the head of a pin that people get tied up in would all go away because people would want to make money, and the people who were willing to jump in would jump in, and it wouldn't be a problem. Just to review the history here, this was initially set up as a common securitization platform. That was a word, that was part of it, the CSP, Common Securitization Platform. Very quickly it morphed into a Fannie-Freddie securitization platform, common between them. You might ask, well, why did it take so long for that securitization platform to be put in place? Couldn't have been that difficult. Well, the answer was it was not in Fannie Mae's interest to have that platform ever see the light of day. The only entity of the two that was benefited was Freddie Mac, because Freddie Mac had the pricing disadvantage for a couple of different reasons I won't go into, but they'd had a 30 or 35-year pricing disadvantage to Fannie Mae, and so they're the only ones who benefited. The great news for Freddie Mac is they get a securitization platform that Fannie Mae paid 60% for, and they get to use it, and Fannie could have cared less. So that's where we stand today.
Thank you. Other questions? All right, Bert, we're going to give you a second question only if we don't have anybody else. All right, and we'll make this our last question, I think.
Thank you. What is your thought about the private label MBS market? Is it coming back? And if Fannie and Freddie, in fact, go into kind of a slow death and gradually shrink, doesn't the private label market have to come back to, in effect, fill that funding gap?
Yeah, I think our view, my view, and I think Ed's view too, is that the reason private label has not come back is that the GSEs are interfering with it. The GSEs are holding back the private label between what the banks buy and hold, which is probably about $3 trillion, and what Fannie and Freddie are working with. And so there isn't really any place for the private label group. But as soon as the Fannie and Freddie are eliminated, and that I think is bound to happen at some time, then the private label market will develop again. Now the trouble is that everyone who counts in Congress right now, that is to say not only the Congress people but the interests, the housing lobby, are quite happy with the way things are today. And so if it is true, as I think it is, that the administration will find that it cannot do what it is hoping to do, that is to recapitalize these companies and release them, 4 years from now, 5 years from now, they will still be in existence until some enlightened president and Congress, or just the president and the director of the FHFA, decide that the only way to eliminate them and to reawaken the private sector, as you suggest, is by gradually, as Ed suggested, taking them out of the market. And once they're out, the market can develop in a natural way.
On that thought, we will conclude. Thank you, ladies and gentlemen, for being with us, and thanks for the panel.